Good afternoon, everyone. Welcome to our webinar today, which is about dumping your debt. We're going to talk about strategies for debt repayment and probably throw in a few tips for this time as well, that we're in very unprecedented times in a lot of different ways, even in thinking about debt repayment and how that works. So we'll get started today by introducing who we are and what we do. My name is Sarah Scruggs. I'm the Community Engagement Specialist here at the Harvard University Employees Credit Union. And for the second half of our presentation, we'll have on Migdalia Gomez, who's our Community Engagement Manager. And just to get us set up for the day to be successful, we've gone ahead and muted everyone on the call except for me and my co-presenter so that hopefully you're able to hear us. And just remember too that hopefully this is a great presentation where we can interact with each other. That doesn't mean that you'll be speaking at all, but we hope that you can chat us and let us know your questions. And the best way for us to know that you know how to do this is for you to go ahead and find the questions or the chat feature either on the right-hand side of your screen or at the top of your screen, and let us know where you're joining us from today so that number one, we know you can hear us, and number two, we know that you know where the questions feature is. Afterwards, the presentation will be made available to you via email. We hope to get that email out by tomorrow evening so that you have this information. You can go back and look. This presentation does come with a lot of examples of numbers and different things of that nature. So please know you don't need to take notes on anything if you're hoping to have these slides afterwards. And then there will be a survey available, and this will come with when in that email. So we do ask you to take that survey so that we can continue providing these webinars to you all at DFCI, as well as all of our other members as well. And speaking of this webinar, we do have another webinar coming up, Crush Your Student Loans. During this time, there's a lot to think about, and student loans are part of a lot of our debt, I think. So we'll touch on them today very slightly, but we'll go more in depth about student loans at our next webinar. And if you're interested in watching any of our past webinars, you can go to webinars on demand as well. So this website, huecu.org/DFCI, is a great resource for you to see what's coming up and what you can, what you can register for, but also what we've done in the past. HUECU, or the credit union, is a not-for-profit financial institution here at the Harvard community. And so we provide everything that a bank does, but we believe we do it better. We are more focused on our community through events like this, free financial education, as well as through making sure that you're personally recognized by our members. So we hope that these webinars are helpful for you in your personal finance journey. And if there's anything that we can be doing better, we'd love to hear from you. To dive right into our topic today, I want to get started with, where are you now? This is a big question. We won't go into all of the existential meaning of this. We'll start just with how this relates to our debt and our money situation. So the best way for us to really take into account, okay, where are we now? We have to list out our debts. I think of myself and Migdalia as pretty fun people. And specifically with this presentation, we talk a lot about kind of looking back, seeing these debts. This can be a tough thing to do. It's not always going to be the thing you want to do on a Saturday afternoon, but it's going to be the best thing for you to do. So you need to go ahead and list out all of your debts. You need to list these out so that you can see exactly, number one, your balance, and number two, the interest rate. These two things are extremely important. I also recommend listing out the monthly payment that you're paying currently on these debts. And so that way you can get a full picture of, okay, this is what I'm paying every month. These are the things that I know. I know the interest rate, I know the balance that I have. And I think a lot of us right now are really looking for how we can lower those interest rates, or maybe thinking about lowering those monthly payments. And so this will give us the best picture of where we are right now, so that in the future we can make those better decisions for ourselves, whether that be refinancing or something of that nature. You can find this handout on huecu.org/hub, but you're more than welcome to also go ahead and just put this into an Excel spreadsheet or list it out on a piece of paper, whatever way works best for you. Now you're going to, once you've listed everything out, you'll need to calculate the cost of your debt. So this means truly sitting down, getting down to the numbers, and looking through everything. So we do have calculators on our website, as well as many financial institutions have calculators to be able to see all of these things. So what I recommend to do is, if you could use one of those calculators, it will give you these numbers without you having to do all the multiplying, dividing, all of that good stuff that we probably haven't done in quite some time. And so when you calculate out these things, you list the amount, the interest rate, the terms, so how long is that loan, and then what you're paying monthly. And then you'll see the total cost of the debt. So the total interest paid is what we're kind of talking about with that cost of the debt. And so this number really gives you a clear picture of, okay, these are the things I'm paying on top of what I've already borrowed. And that gives you a better idea of how you can save money. So I think it's best to sit down and go through these with every single one of your loans or money borrowed that you have. So that's important to do. Like I said, may not always be the most fun thing to do on a Saturday afternoon, but it's a good thing to know. And then total it up all together. This is an important thing because this gives you those real numbers. Whereas if you're listing them individually, it's not going to actually tell you what you're paying fully in a 1 month. So you'll see here that they've added up the amount of debt, the monthly payment, and then the total interest that they're paying. So you'll see that final number is quite high for these two debts that they do have. So where do we go from here? Roads to repayment, speaking about how we can repay this debt that we do have. Most people in the United States do have debt, and most people are wondering, what's the best way to do this? How do I move forward? The first thing is looking for lower rates. A lot of people right now are looking for lower rates. You've probably heard lower rates are popping up everywhere these days, as you probably have heard from the news and from other financial institutions. That definitely is the case. A lot of financial institutions are trying to help out their customers at this time, understanding that our lives are completely different than they were just 6 months ago. And so you'll see lower interest rates pretty frequently, I believe, especially if you've gotten the loan within a year, 2 years, you'll see lower rates. And so where do you look for lower rates? Where's a good place to go? Well, when you're thinking about credit cards, that would be a balance transfer. So if you have credit card debt with company A and you want to move it to company B, then you could do what we call a balance transfer. There could be a lower rate on the card, or if you're thinking, I can pay off this credit card debt within 1 year, some balance transfers will have a 0% for 12 months. And so if you're able to do that, that could be a good rate for you. Personal loans. We've seen our personal loan rate drop at the credit union, but I'm sure other financial institutions are seeing this as well. So if there are personal loans that you need during this time, maybe this is a good time to refinance that. And debt consolidation loans. Just recently, the credit union announced that our debt consolidation loan rate has dropped because we want to make sure that we're helping our members and that other financial institutions are thinking the same thing. They want to be there for you. Student refinancing loans. Like I said, we'll touch on these, but I don't want to go into full details. We will speak about crushing your student loans in just a few weeks, and we'll focus and dive deeper into that. So there are two reasons why you would look for a lower rate. The first would be you could possibly extend the terms, which means if you need a lower monthly payment, you can stretch out your loan a little bit longer so that the monthly payments are smaller. So if you're worried about loss of income or things of that nature, this could be a good option for you. And there's also the benefit of it possibly being cheaper. If you're able to pay the monthly rate that you're at right now, maybe there's an interest rate that's lower out there, but you can continue to pay that monthly rate that you already have, then you'll pay it off quicker and save a little bit of that interest money. So there are benefits to repayment, but know that these also come with conditions. So any of the benefits that you had previously with your debt, those don't transfer if you refinance. So you need to keep that in mind. I especially speak of that with what has to do with student loans. And the reason that we say this is because right now, student loans are at 0% interest through the federal government. So if you have a federal student loan, let's say that you have one unsubsidized federal student loan, we don't recommend refinancing right now, because right now until September 30th of 2020, and who knows, it could be longer based on what the government decides, but right now until September 30th, you do not have to pay your student loans federally. You do not have any interest accruing on those federal loans. So we don't recommend that you refinance those federal loans right now. But maybe you're looking to consolidate those loans. This consolidation combines all of your loans into one, and it will take the average interest rate of the loans that you're paying right now. And then private refinancing. Let's say that you already have a private student loan and you're thinking about refinancing. We definitely recommend looking around for lower rates if you are moving from one private company to another private company, because there could possibly be better rates out there. And these rates are typically based off of your credit. So that's an important thing to know as well, is that your credit is very important when you're thinking about debt repayment. And like I said, the conditions and the benefits when if you decide maybe in the future when there's not a 0% rate on student loans through the federal government and you decide to refinance privately, you would lose any federal benefits that came along with that, like if you were possibly on an income-based repayment plan or something of that nature. Another thing when thinking about refinancing, you're going to want to think about tax laws. And there are a lot of taxes that can possibly be written off or get a deduction for. So with student loan interest, you can get a deduction up to $2,500, and then home mortgage as well as home equity. So it's important that you find this information. If you're interested, you can visit the irs.gov or speak with a tax professional. And the tax professional is always going to be your best bet because they're able to look up these IRS laws and codes, and that way they can tell you the information specific to your situation, because some deductions may not be applicable based on certain things that have to do with tax laws and codes. Like I said, credit could impact your ability to get a better rate. And so we always have people ask us, what should my credit score be? Well, I tell people, get it as high as you can. That is the goal, of course. But you can see on this chart how credit scores really do impact your interest rate and the amount of money you'll be paying in addition to what you're already paying. So you'll see that someone with a 500 credit score is going to be paying a much higher monthly payment than someone with an 820 credit score. So sit down and think about your credit score. That's an important piece of this puzzle, because you'll see additional costs once they have paid off this car loan. Those add up quickly. $5,000 is a lot that you could have in your pocket to be saving for something else, or even paying down this loan more aggressively. So you really want to think through, is this the right time for me to refinance based on my credit score as well? Or maybe when you're thinking through this, do I want to possibly get my credit score even just a few points higher and then apply for refinancing? Those are really good questions to ask yourself, so that hopefully when you do go to refinance any of your debt, you're able to get the best interest rate possible. And something that is good to know is that every lender does it differently. So some lenders use your credit score to get that interest rate. Some lenders don't use it or rely on it as much. So that's good to know as well. One thing that we really recommend is that you go to annualcreditreport.com and pull your credit report for free. Yes, it is a .com, but know that this is the only website that's authorized by federal law to give you your credit report. So this is what it should look like when you go to the website. We pulled this straight from the screenshot so that you can know that this is the one that you're supposed to go to. You can receive a free annual copy of your report from each of the 3 bureaus. And yes, it is important to pull all 3. You never know which report a lender might have. And so it's important to pull all 3. And right now, during coronavirus, annualcreditreport.com decided that it was important enough to make sure that everyone had access to their credit reports more often than one time a year. So Annual Credit Report is offering them free every week from the 3 bureaus until April 2021. So that hopefully if there are any mistakes that come up on your credit report, you can catch those a little bit faster so that it doesn't impact your score. So it's important to keep up with this, maybe not every week, maybe it's not changing every week for you, but once a month is a good idea to go ahead and sit down and see if there have been any changes, if anything has been reported incorrectly, so that you can make sure you're keeping your credit score high or that you're improving your credit score if it's not where you want it to be just yet. Comparing your options. When you go to think about refinancing your debt, there are going to be a lot of options. If you're anything like me, sometimes that can be overwhelming. But we don't want that to be something that, strikes fear into you and then you end up choosing nothing. I think sometimes we get that when there's so many options and we don't know really which one is best for us. We end up getting too scared to pick any of them. So we want you to go into this process with resources, with ways that you can figure out which option would be best for you. So let's take 2 different offers. You have this $10,000 loan and it's at 21%. And you're able to comfortably pay $300 a month. So you've built into your budget, you've seen that you can pay $300 a month on this debt. So what is the best thing to go ahead and do with this? Would it be to do the 1.99 balance transfer for 12 months and then 10.99%? That definitely drops us down a lot of interest. So that could definitely be a good offer. Or would it be a debt consolidation loan at 7.99 for 5 years? So you see these 2 offers, and this is something that a lot of people will see. You'll see that you have the option to possibly do a credit card balance transfer, or you could do a debt consolidation loan. And how do we know which one we should choose? The best thing that you can do is to sit down and calculate this out. So I hope right now you're thinking about which one you would do. Obviously, quick math to ask you to do this. So I'm going to spell it out on our next slide. It depends. And we say this because these 2 options will give you different benefits. So if you're really looking to have a lower monthly payment, one will benefit you more. If you're looking to have, shorter terms, but a better interest rate, one may help you out a little bit more. So it's interesting to pull both of these up. So if we were to pay 1.99% for 12 months, those payments would be $842. And we said we could comfortably pay $300. So that's not going to work for us to go ahead and pay it off in 12 months. And the total interest there would be $108. That sounds great, but we're not able to pay $842 a month. So we would need to do $300 a month, and we would pay off the balance in 38 months. And the total interest would be $964. So those are two things to think about when you're looking at the credit card balance transfer. You see that 1.99 and you're like, wow, I dropped that interest rate by almost 20%, which is true, but only for 12 months. So you do need to remember that those, that you're not able, if you're not able to pay it off in 1 year, those benefits may not help you as much. And so, like I said, those first 12 months were 1.99, but then they turn into 10.99. And then the other that could possibly be part of it is doing the debt consolidation loan. So for $203 would be your monthly payment for 5 years. But again, that interest would be pretty high if we're paying it off in 5 years, okay? But remember that in our budget, we were able to pay $300 a month comfortably. And this would pay off our balance in 38 months. And our total interest would be $1,343. So you see on this slide that after we calculated it all out, it would actually be best to go with the credit card balance transfer because that's going to be saving us that interest money in 38 months if we're able to pay it off in 38 months. But something to remember about balance transfers is that because you transfer it onto a credit card, you could still rack up more debt using that credit card. So we need to be extremely careful when we're thinking about our debt and our balance of debt when we put it onto a credit card, because we don't need to be buying anything additional. Whereas with a debt consolidation loan, we're not able to continue spending on that specific debt. So those are two things to keep in mind. I'm going to turn it over to Migdalia Gomez, who is going to take us down and start with some repayment strategies.
Thank you, Sarah, and thank you everyone for joining us today. So as we're talking about debt repayment, there are a couple of different ways that we can do that. We can take the existing debt that we have and hopefully improve our credit score or take advantage of historical low rates, such as the ones that we're experiencing right now, and do some debt refinancing. And just to put into context, in case it's a little bit helpful for individuals, if you have a credit card that is a credit card balance and have a credit card that the rate is anything above, I'd say 15, 13%, I would definitely look into other credit cards at this point, or contact your credit card company and see if they can lower the rate for you. Because of COVID-19, a lot of credit card companies are being much more flexible and offering temporarily to lower their interest rates. If you have a vehicle loan and that rate is anything above, I would say 3%, definitely look around. You can get a lower rate, you can refinance. If you have a mortgage, they're as low as, they were around 2.5 not too long ago. I haven't checked today, but anything, if you have a mortgage above 3.5, 3.25, definitely look around, and we'll give you much more information as to who you can contact and how you can get more of this information. And then for student loans, anything above 7% or 6%, outside of the federal, remember that the federal rates are right now at 0. And I think I touched upon all of them, talked about mortgage, personal loans, Sarah mentioned, right now the rates are about 4.99. But if we're not able to refinance, maybe we already have a really good rate and we decide, you know what, it's not really worth it, I don't want to do it right now. And for some context, the refinancing process, typically depending on who you work with, it'll take about a month and a half. So it's not something that really is that, it's not that challenging. It's fairly simple and straightforward to refinance. Even if it's a home, you can typically do it nowadays within a month and a half, depending on the lender. Now, let's say that we have those rates, we're able to get a lower rate. We either waited for our credit score to increase, or we decided, you know what, let me just lock in that low rate now, and in a couple months, maybe I'll look and see again. There isn't a limit as to how many times you can refinance. But we went through that, we have that lower rate, or we have the current rate and we decided to stick to it. There are other things that you could do. You can take a look at the amounts that you're paying monthly, and that's what I'm going to focus on now. It's some strategies on, now that I've looked for that lower rate, now that I feel that that's one of the, and that's typically the way you're going to save the most money, which is why we spent so much time on it, is that searching for that lower rate. But in addition to that, there are other things that you could do. One of the things that I personally have done, and I enjoy doing this, and Sarah and I meet with members, and this is something that's been very successful for our members, is listing out all of the debts. As Sarah mentioned, remember, you need some sort of document, whether that's an Excel, whether that's a pen and paper, whether that's the handout, whatever works for you. You're going to list the debts, you're going to have the amounts. And if you're the type of individual that you like to cross things off a list, the snowball method of repaying your debt was going to help you. What the snowball method means is that you're going to take your debts, and let's say that I have a $5,000 debt, I have a $500, and I'm just going to use simple numbers and simple examples, but let's say that I have that $5,500 debt. And at this point, we don't really care what the interest rates are. We just care that the $500 debt is smaller, and we're going to try to tackle that first. So what does that mean? It means that I'm going to pay the minimum balance on my other debt, and any additional funds that I have, I'm going to apply them towards that $500 debt, because my goal is to be done with that. So instead of having 2 outstanding debts, I will only have 1. This tends to be very successful, especially if you have 5 or 6. If you have multiple credit cards, if you have a car loan, if you have student loans, multiple loans that you're paying off, depending on your repayment schedule, you may have to wait 8, 9, 10, 30, 20 years to see any debt being paid off. So what the benefit of the snowball is that you're going to be able to have small victories, and this, based off behavioral economics, is one of the ways that people tend to be more successful, because you're seeing a goal, you're checking it off. If we think about weight loss, if someone's trying to lose 20 pounds, you're not going to lose that overnight. But if you're setting weekly goals of a pound or 2 or 3, by the end of the month, that's small enough, and that's going to help keep that momentum going. Another way of doing this for debt repayment is avalanche method. Now, the avalanche method is going to be focused on mathematically what is going to save you the most money. That means I'm going to list my debt, and I'm going to list them by interest rates. So my highest interest rate, that is what I'm going to apply the most money towards. Everything else, I will just pay the minimum balance. This will take typically a little bit longer. So if you're, let's say that we'll go back to that example of the multiple debts, some that might take 20, 30 years to pay off. If you're okay waiting until 10, 15 years to check something off the list, the avalanche method might work for you. Historically, we've seen that snowball just because of the need for small victories tends to work, but this is where it is personal. And this is also where it's important to go back to that question that Sarah asked, where are you now? And part of that is creating a budget, going through your budget and saying, okay, how much money do I have that I can apply towards my debt repayment? Because even if it's an extra $10, $15, $20, that can make a huge impact, and I'll show that in the upcoming slides. And then you have the sprinkle method, which is probably what most of us will do is, oh, you know what, my minimum balance is $30, let me pay $50. Oh, okay, here, oh, I have an extra, I had some overtime this week, let me put that extra $10 towards here. That is when you're not necessarily have a specific strategy other than sending the money as you wish. As you're going through this, there are going to be times with debt repayment that it's going to seem frustrating because you're making the payments and you may not see that going down. You may not see your balances going down until you get closer towards having paid most of the interest, so that your payments go primarily then to principal. And that is going to be the case with essentially all your debt. That when you make a payment, let's say it's a $100 payment, if I'm paying $100, but my balance is $5,000, that $100 is primarily going to go towards interest. And then the remaining, maybe, and I'm making up numbers here, but then maybe the remaining $10, $20, that's going towards the principal. So that is why when you're in a repayment strategy, it is good to have something to focus on, and going back to what is driving you, what's motivating you. When we're thinking about debt repayment, why are you doing this? Are you doing this because you're saving money for a wedding, because you're saving for retirement? Are you doing this because you just want to be debt free and want to maybe increase your emergency fund? Whatever that may be, at times that it gets challenging, it is good to go back to that to help you stay on track. Another suggestion sort of along this terms of what motivates you is keeping in mind that there are going to be times that things will happen and you may go off track. You may not be able to pay, you have your budget, you were trying to pay $400 every month, but maybe something happened this month and you can only pay $350. It's okay to be, have one of those, two of those off months. Keep in mind that you're in this for the long term. And as you're going towards your debt repayment, you also want to put money aside towards emergency fund, because if we go through it, I'll go through some examples in a few. If I have, let's say, $500 that I'm allocating towards my debt repayment, but I have zero in an emergency fund and something happens, what's going to happen? I may have to charge my credit card again. So I'm going to be back in that loop. Now, if I have that 500 that I have allocated towards debt repayment, maybe I put 450 towards debt repayment and I put 50 towards an emergency fund. That way I am, when something happens, and the reality is when, not if, but when something happens, I have that emergency fund and I don't have to feel discouraged because I have now utilized my credit card when I was trying to pay it off. Now, this is going to seem like an odd thing to have up on a slide. It's going to seem like an odd thing to even say, and that's why I start off with that. Who has an extra $10,000 payment? Most of us do not. But the reality is, most of us may have received an economic impact payment. You may have filed your taxes and received a refund. There may be a bonus. There may be a payment that you were making that no longer has to be paid, and now you have this influx of cash. And yes, before there are other competing priorities, there might be something else that we want to allocate that money to, but we wanted to just take a moment and just break down what is something that you can do to try to help you determine what is the best way to allocate excess funds that you may come across. One of the things that you could do is, first, and we always say this, is list out the debt and calculate what is the total cost of that debt. These numbers will be big, especially in this example, we use the 15-year loan for the student loan and the 30-year mortgage. So the interest that's going to be paid will be substantial. If none of you have ever done this before, sorry to be the one to sort of show you the hard numbers, but it is important to see that, because by just visually seeing, I'm going to pay how much in interest if I do nothing else, that may be enough to motivate us. We might decide, oh no, I don't want to pay $30,000, $31,000 in interest. I have to do something. And that might be enough to help give us that extra little nudge that we need. The next step is, once we know what our original starting point, and you could do this, and I recommend doing this, I've done this, recently did some refinancing myself and I did this, is list out your total interest, that's going to be your basis, and then see, what if I apply it to X? What will that mean in the long term? In this case, if I have a $50,000 student loan, and that I take $10,000 and I apply it towards that, I'm going to save myself, in this example, about $6,000 in interest. And that's a one-time upfront payment. Well, if I did the opposite and I instead applied it towards a mortgage, or in this case, if I did it towards a down payment, I'm going to save about $10,000. So in this specific situation, if I have the option, and we see this often with individuals that are trying to purchase a home and also manage student loans, and they're like, well, should I accelerate student loan repayment? Should I accelerate credit card payment? And this is something that we're seeing right now as well. Some folks, and it's actually not just us, it's across the nation. A lot of individuals are paying off their credit cards balances, which is great. It's a good thing. But in doing so, is that the debt that they should be focusing on, or is there another debt that could be more beneficial to them in the long term? And this is where it's important to run your own numbers. We are talking very high level. We're just giving examples. Every situation will be different. It's going to be based off the terms. It's going to be based off of the interest rate. So this is just an example of calculating so that when you have those extra funds, have a better idea as to where to allocate them to. These are some other strategies, and we have a couple additional slides, but if anyone has questions, feel free to use the chat feature or the questions panel to submit questions, and we'll make sure to leave time to answer those. But these are some additional strategies, and this is all about combining everything that we've spoken about. So when you're trying to outsmart your debt, you don't have to just do one thing. Doing a combination of all of these will save you some money. Now, this is an example of a loan, 18%. It could be a credit card, $10,000 credit card balance at 18%. That's very common. Most credit card balances, unfortunately, carry fairly high interest rates. And if you're paying about $254 monthly, that's going to be $5,236 in interest. So that $10,000 loan really is going to be $15,236. Well, the first thing we want to look at is refinancing. And it might seem like, 8%, can I really reduce my rate by that much? Yes, it really does depend on what you have. If you have debt that you've had, I'd say for more than 4 years at this point, but even 3 years, the rates have changed significantly. As you know, with the markets, rates were dropping, and then with everything that has happened with COVID, the rates have remained low, and organizations, and I'll speak for us as a not-for-profit, like Sarah said, we dropped our rates significantly to help our membership. So it is worth looking at this periodically. You do not get, and you can also shop around. And if you are trying to, let's say, refinance your mortgage or refinance a car, you can shop around to a couple of different lenders within a 2-week period, and that inquiry will be treated as one inquiry. So yes, it will impact your credit score, but that will give you an opportunity to see what your rate could be at 2 or 3 different institutions, and you can decide which one's the best one for you to go with. That is based off of the product. So if I'm trying to refinance a car and I go to 3 or 4 different lenders within that 2-week period, that is going to be one inquiry for an auto loan. But if I were doing an auto loan and a mortgage, those are 2 different categories. So those would be 2 different inquiries. Refinancing is going to give you a new monthly payment. Typically that rate reduces, so your monthly payment will reduce, and you can keep the same term with most of the lenders. Not all, there's some things every lender will be different, but I could say I want a 5-year, so I want to keep the same term that I have, and that will give you a monthly payment in this example of $212. But if you are already paying $254, then I would recommend sticking to that. If you're comfortable with that amount, sticking to that amount, that's going to help you pay off that debt faster. And I also recommend rounding it up or going to an amount that is a little bit easier to budget. $254, it's an interesting number. $275, it's easier. Or $300, like, okay, I can do $275, I can do $300. There are 2 things to think about when you're doing these strategies. You're not only looking to save money, I mean, that's really, for most of us, is going to be the driving factor, but I want you to also think about the time that you are saving in refinancing, in debt repayment strategies. You can save, in this example, let's just call it 4 years. 4 years, so you can be done much faster if you maintain this. Now, this means it's for mortgage, for a car loan, for student loans, some products, it may not make sense. You may not want to accelerate. But if you are able to, that's time that you can now have that money to go back to that initial goal that you were thinking of. So let's say that I am trying to save for a wedding. Well, maybe my goal is to refinance and pay it off so that by the time I'm married, that's one less debt that my partner and I have. So these are, or if it's for retirement, maybe you want to say, I'm going to retire in 5 years and my goal is to be done faster. I want to be done so that when I'm in retirement, I don't have to worry about having this debt. Everything that Sarah and I went through today, we use our own calculators. There's a section of our website, it's not listed here, that you can say how long will it take to pay off my debt. You just put in the basic information that we went over, interest rate, monthly payment, and what is your balance, and it will show you your interest that you will be paying and how long it will take. And it will also show you that tipping point, that point in which you're no longer paying mostly interest, but the point that you've paid enough of the interest down that now your payments are being applied towards principal. And that's a really important piece, because that tends to be when more of us become motivated, because we start seeing that that balance really starts to go down. There are going to be times that the debt will just be higher than your income, and or I shouldn't say higher, but your debt may make it so that it's not manageable given the income that you have coming in. So there are other things that you could do. One of them is called a debt management plan. And a debt management plan is when you work with an outside company, a not-for-profit, and they essentially work with you. You have a consultation, they help you create a budget, they list out all your debts, and then they look at what is feasible for you to pay given the money that you have coming in and your other expenses. These not-for-profit organizations work with the lenders to be able to reduce your interest rate. For example, I could have debt with company B, and maybe when I have that debt with company B, they're charging me 18%. But if I put that debt in a debt management plan, they might charge me 5%. And it sounds very extreme, but we have seen that. We have members that are on these plans. And the reason that the rates will be much lower is because you essentially work with this company. We work with Green Path Financial Wellness, and they will calculate how much your monthly payment will be on the debt management plan. You send them the money, and then they send it off to the different companies. So because someone else is managing that piece for you, a lot of the lenders will typically reduce the interest rates much lower because they know that someone else is working with you and this is a plan. These are highly regulated by state, and it's not debt settlement, meaning that if my outstanding debts are $10,000, I will pay that $10,000. I'm not going to pay just $5,000 and then have that settled with the company. Debt settlement typically will have a very negative impact on your credit report and your ability to borrow in the future. A debt management plan, it will impact your credit score at first, but it will recover and you do pay off your debt. And it's a plan. You really work with someone to create a plan for you to pay off that debt. There is a cost for it. It's $10 per account, but the maximum being $75. So that if I have 8 accounts that I want to put into it, in Massachusetts, I would only pay $75. I wouldn't pay $80 or $90 if I had 9 accounts. There's a lot to go into these. We are going to email everyone the presentation, so you'll have access to this. But more importantly, I would say, I always recommend contacting Green Path Financial Wellness. They are accredited credit counselor. They do budget counseling. They are also doing COVID-19 counseling. You do not need to be a member of the credit union. We would love for you to be a member, but if you're not a member, this is still available to you because as a not-for-profit financial institution, our interest is in you being financially well and everyone in your household being financially well as well. So we extend this to you and anyone within your household. They could go over budgeting, credit, COVID counseling, and if you're in a situation that a debt management plan may make sense, they'll go over that, but you do not have to sign up. And all of that is free. We pay for it, so that is a free service to you. I know that we went through a lot of steps, so I want to do a quick little recap of sort of next steps, and then we'll open it up. If anyone has questions, we'll definitely open it up as well. The biggest piece is if you're going to refinance, you first want to understand what do you owe, and you want to work on having a good credit score. Using our calculators or on your own or other calculators, identify what is the cost of that debt that you have, because that's going to help you understand if a refi makes sense, if that additional payment makes sense. It gives you a basis of comparison. And knowing that, yes, it may make sense to pay the highest interest first, but if you need a small victory, then paying off the smallest balance may make sense for you. Or if it doesn't, if you don't mind waiting 2 to 3 years, then go with that. It's whatever's going to be best for your personality. And the toughest part, I will say, of debt repayment isn't necessarily doing it, it's the reducing and not adding additional debt. And this is where it's going to be important to have that emergency savings aside and have a strategy so that you're not adding on additional debt, so that you can truly see the benefits of your repayment strategy. If anyone has any additional questions, we will be here. For those that may have to log off, just know that we are here for you. You can follow us on social. We also have a blog where we provide additional information that's timely based off of other personal finance topics.